But we start, people will hear you, see you.
आ गया आ गया yeah
Right? Now,
is it okay now? I have done that. Is it okay? फुल स्क्रीन कहाँ से करूँ पता?
slideshow from the current.
हाँ लेकिन कर दिया मैंने.
Don't shut anything.
Okay. I'll start. How many? Okay.
बड़ा कर एक वाइप इसी लो.
Good morning, everybody. So sorry for the delay because there was some inherent issue with the network. But apparently we are all fine right now. And I hope to carry through the session on crude, the impact on the macros, and the impact from a micro perspective as well. So two aspects here. One is obviously how the fall in crude impacts the fiscal health of the country. What implications does it have from an inflationary perspective, and what impact does it create on stocks and sectors? So with this, I think the disclaimers that we start with, the stocks discussed is only for educational purposes. It's no recommendations in terms of buying and selling, and in no way should be construed as an investment advice. Now, a lot of things have happened over the last few weeks, specifically in the last week when uh, crude prices dived down, specifically the WTI prices, and they went actually into the negative terrain. Again, I think the kind of impact that it has in terms of oil and gas prices across the globe, I think that itself is a very prominent sign that we as investors should be watching out for. So I'll take you through a very interesting graphic in terms of how crude price movement has happened over the last 3 decades. Now, anybody who has been a proponent in terms of crude price movement would see that if you go beyond the last 3 decades as well, the OPEC was basically created to channelize crude production and to channelize crude production in a structured manner so that the pricing probably stayed very, very strong with all the oil producing countries over a sustained period of time. Now, the cost of producing crude over a period of time, obviously, I think it's become very, very volatile at this point of time, both from a logistic perspective, a cost perspective, as well as the demand supply dynamics. But at that point of time, I think with the expectations of crude which was available at accessible surfaces, the cost of producing crude was quite manageable for oil producing countries. And then the price at which they obviously sold, I think they made a huge amount of money on that. So I think all the oil producing countries have actually seen their GDP rocket once the discoveries of a lot of these oil fields were made over the last few decades. What has also happened in terms of all the developments that have taken place over the last 3 decades are equally noteworthy as well. So oil prices obviously react to events that surround how the dynamics related to demand supply will move out. Obviously, I think a lot of oil reserves were situated in the Middle Eastern region, the Russian region, a few of the Latin American countries. And therefore, I think the prominence that OPEC had, and with the formation of the non-OPEC bloc as well, probably counting these guys, I think a lot of events which transpire in the middle have probably determined how oil prices will be. So I think the latest that one probably thinks about is the Gulf crisis between 1986 and so in that decade between 1985 and 1995, where oil prices had spiked up quite significantly. Now, for oil importing countries like India, I think what really matters and what really determines the dynamics is how the entire situation from a demand perspective and supply perspective from both the suppliers probably play out. What you probably saw in terms of the peak was in 2008 when oil prices actually rallied close to 140 $150 a barrel. And the sustainability for a lot of oil importing countries, including India, and the kind of impact that it had from a fisc perspective, from a current account deficit perspective, was very, very onerous because I think we did the maximum hit at that point of time. And again, I think how the currency plays out plays an equally important role. So I think this graph has been a very important timeline on how oil prices have probably moved. So it's like the market movement itself. If you map out how the Sensex was 20, 25 years back and where it is, I think it's been an upward trajectory graph for oil as well. I think the counter arguments for oil at this point of time is how electric mobility and the developments thereof take place. So I think that's a very interesting argument, but we'll keep that for later on how that progresses over the next few years. Just a humorous way of looking at this, specifically after the fall that we saw and witnessed last week. So on a week-on-week basis, that is on a 7-day basis, I think the kind of precipitated fall that oil prices saw, specifically WTI crude, I think was it week over week or week over week, and will they continue remaining weak over weeks to come? I think that is what is the question that we need to answer, and that is some point that we will ponder about over the next few slides as well. I think the most important question was why did Brent WTI actually turn negative? Now, obviously, I think all of us have read through articles on how the negative terrain was witnessed for WTI. Yeah. So WTI is nothing but the West Texas Intermediate crude, and it's an area within the United States of America which is landlocked and which is quite at a distance from the shores itself. And again, I think the kind of crude that gets processed uh, from a WTI perspective is extremely heavy crude. So there are also different varieties and variants of crude that one really witnesses. So again, I think if it's more heavier on the WTI side, there is a sweet and a sour variant as well. There is light crude as well, and therefore I think the refineries which come into play should have the capabilities and the complexities to process different types of crude, to process different types of meat. So for industrial uses, I think you don't need crude to be refined to the micron level that one needs for use in vehicles, for example. So in that respect, again, I think the Nelson Complexity Index is extremely critical to gauge and judge, specifically from a refining and a refining complexity perspective as well. So refiners all across the globe have different grades in terms of the complexity and the complexity indexes that they have. And the higher the complexity needs, the higher the capacity and the skill or processing capacity to process different types of crude, the heavy light heavy variants as well, and that itself can give you better dynamics in terms of pricing when it comes to the overall gross refining margins that these companies ultimately report. Now, again, I think why did they go negative? Obviously, we would have read through a lot of articles in terms of how crude has gone into the negative terrain. But again, I think it's a futures contract, right? And futures contract works on certain principles of demand and supply. Yeah. Now, with the corona pandemic, I think a couple of reasons could be broadly attributed to why the fall was accentuated as it was, specifically in the last 2 days of the May expiry. Again, I think there was a huge amount of disparity because you could see the June contracts actually hover around 20, $21. But the two basic broad reasons since the rise of the pandemic and the rise of the cases specifically on US shores and in the Western markets and the emerging markets as well, I think the demand was expected to go down significantly. So from a June future perspective, contract perspective, it was more or less assumed that demand should start coming back on a more scalable basis. So I think the two basic reasons was there was a sudden crash in terms of demand, and nobody was expected to take deliveries off. So I think with demand coming off significantly, then the rig count actually getting closed, and the demand actually coming off quite significantly than the rig count coming off. I think the storage tanks were filled to the brim. So what basically took place is that there was no storage to load the existing crude at this point of time. So even if deliveries were taken, there were no capacities to probably store this, and demand was obviously drying up. So I think it's the first time in history that we obviously witnessed, and it was late in the night when news started trickling in terms of the negative rates that WTI crude was quoting, and it went as low as negative $37 to a barrel on the expiry date itself. Now WTI has bounced back with the expectations that there is some hope and revival in terms of marginal demand coming through. Lockdown pressures being eased across the globe, and as demand starts coming back, there would be that storage capacity that gets vacated, which will create buffers for additional storage or the existing storage to manage additional deliveries that are taken off. Now, the second element here is also the rig count. So I think on one hand, we talk about how the OPEC prices have behaved. On the other hand, we are also talking about in terms of how the statistics in terms of OPEC and non-OPEC producers stand at this point of time. IMF has clearly given a clarification, and also I think the OPEC producers have said that global demand may actually come down quite significantly for the first half and even on an annualized basis at this point of time. So I think the rig count on the producers within the US market, I was just going through the data late in the night yesterday, and the rig count has actually come off quite significantly. So I think the rig count has actually come down almost 53 odd percent. So on a year-on-year, on a comparative basis, when you're talking about 806 odd rigs being active at the same time last year, you're actually down to almost 378 rigs which are active at this point of time. Clearly, I think the cost of producing shale and oil in the US at this point of time has become far more expensive, with where WTI Brent has settled at $17 odd dollars, where crude has settled around $21 odd dollars at this point of time, and demand obviously not being there. I think both the pricing dynamics not in their favor and demand not on their side has created the rig count to come off significantly. Now, when I was studying the data in greater detail, and I obviously had reliance on the Baker Boots data over the last few decades, I think we've even hit the all-time low that the rig count had gone to 404 on May 20th, 2016. So I think it's a serious implication if Brent, WTI, both WTI and Brent stay at these levels. Because I think the dynamics in terms of producing crude and staying profitable will ensure that a lot of these producers go off. So I think it's a figure that one really guesses in terms of what makes shale and crude production in US profitable. I think the number varies anywhere between 35 to 45, 40 to 50 odd dollars. I think that's the range that we're talking about. And we are way off that range with the current settlement or the current pricing that both these contracts are exhibiting at this point of time. Interestingly, I think its North American counterpart, Canada, also had its rig count slashed. So from 2930 odd active rigs, it's actually gone down to 2526. So I think even the Canadian oil producers, gas producers are feeling the pinch at this point of time. So I think this is one important element that one also needs to take big recognition about on how the rig count is probably placing at this point of time. And because of low prices, a lot of these shale gas producers are actually getting driven out of the markets purely based on demand going off and excessive supply coming onto the market at this point. I think what basically drives crude prices, right? And you spoke about how OPEC was formed a few decades to control oil prices and to control the production in terms of cartelization that the oil-producing countries can have. So OPEC members still contribute 40%, and I'll take you through the graph in terms of the overall production numbers for each individual country at play. Saudi Arabia, I think, is one of the biggest producers at this point of time. Within the United Arab Emirates, Abu Dhabi still has a huge say. Obviously, I think with the restrictions laid out in terms of the Iranian output and Iraqi output actually also coming in a trickle at this point of time, I think anything which happens in terms of a disruptive force, in terms of production numbers, I think it's going to be extremely critical. So I think it's always been laid out on how crude pricing has been with the OPEC production numbers. The non-OPEC obviously also starts chipping in. But I think to control pricing, obviously, production cuts are mandated. What we saw a couple of weeks back in terms of the Saudi and the Russian deal and what happened thereof, the large expectations were that they will come together. Russia backed off at the last minute, which suddenly caused huge crash in terms of Brent pricing as well. After a few days and weeks, I think they arrived at some sort of negotiation where the market expectation was likely that 20 million barrels will be cut off. Actually arrived at a figure of 10 million odd barrels. But there was some element of disappointment for the markets in terms of expectations. But largely, again, I think it was a mandated move because I think it was a survival in terms of all these economies, because all these economies are largely dependent in terms of their GDP numbers, on how oil and gas prices basically move. And at a certain level, I think it does make sense from an economic perspective as well, both in terms of how do they manage their budgets and how do they manage their capital spending from an economic perspective if oil prices remain below the threshold mark that they have probably perceived. So again, from a GDP perspective, with oil prices staying low, I think a lot of hit is being perceived that a lot of the oil-producing nations will take. Because the kind of leeway that they probably get does not exist with Brent staying at $21 and then that itself is an onerous sign as well. I also mentioned in the last webinar that we had, I think a lot of international paper gets floated around, and a lot of oil and gas companies have floated this paper. So I think as their bond repayments, as their bullet repayments happens in terms of interest and debt obligations over the next few quarters and years, I think sustainability of oil prices to ensure that they take care of the obligations of the paper that have been issued to them becomes equally critical. And then again, I think if oil prices remain absolutely low over the next few quarters and months, I think it can be an onerous sign from a balance sheet perspective as well. Secondly, I think, as I said, from a GDP perspective as well, if oil prices stay low, I think the kind of revenue receipts that a lot of these oil producing countries are expected to garner start coming off quite significantly, which means that the kind of expenditure that they need to do in terms of diversification from the oil and gas business, specifically economies like the UAE, for example. I think a lot also depends in terms of tourism, a lot also depends in terms of infrastructure growth. And again, I think as the world moves towards mobility over the next few years, I think how these nations will move up is going to be an extremely important sign. And what will happen in terms of Brent pricing there. So largely, again, I think if you probably see how the production numbers have stacked up, and it's a very important recognition on this part as well. I think you probably look at non-OPEC liquid production and WTI crude prices. I think look at the correlation that they have, and this is in real dollar terms that we are talking about. So if you probably look at pricing and you look at the production stats, I think as production numbers start going up, I think it's an obvious impact of demand supply, right? So if supply starts coming up, I think the pricing starts moving higher. Over a period of time, over the last few years, you'll actually see production numbers actually move up quite significantly, which means that WTI prices in real dollar terms has actually remained very, very subdued. But now with demand coming up significantly, as we've seen, I think it's creating a trickle effect in terms of cuts being mandated, but pricing also not being on the side. So it's a double whammy of sorts for a lot of producers. So as I mentioned, I think the top 10 producers in terms of production of oil, and though United States stays right at the top, I think the cost in terms of producing crude, I think is equally important at this point of time, and the dynamics in terms of running this the rigs and the rig count thereof, as I mentioned earlier, I think becomes extremely critical both from a fixed cost perspective and therefore an operating leverage perspective. Because if the fixed cost absorption is not happening to the optimum level and production is not at optimum capacity, we're obviously expected to see the trickle down effect play negatively in terms of EBITDA and the bottom line as well. So again, I think it's almost 100, 105 million barrels a day that we've got, but the expectation largely is that there will not be enough demand to probably meet this kind of supply that the market is looking at. And demand might actually come off quite lower than what the overall supply is at this point. So I'll just take a second to pause here so that I can actually go through the slide in terms of question. Okay. Now, obviously, I think two aspects. One, I think the WTI impact is what we spoke about, but the Saudi-Russia deal is something which actually started creating a crack in terms of crude prices. So just before the deal was announced, there was a reasonable amount of movement in terms of Brent crude pricing. Obviously, I think once the pandemic news started getting flashed off globally, and as that news started getting gestated, if you can see the levels that crude started coming off, and it has initially started giving signs in terms of the sell-off getting witnessed because people were cognizant of demand actually slowing down if this spreads across the globe. I think around Jan 20th, when crude was actually hovering between 55 and 65 odd dollars, it actually started coming off, and the expectations were largely all pegged upon the Saudi-Russia deal, where everybody expected a huge cut in terms of production to actually stabilize crude prices going forward. So I think in terms of those negotiations falling off, we actually saw a knee-jerk reaction in terms of how Brent was expected to perform. So I think Brent actually crashed down quite significantly, close to the $25-30 terrain. But after the WTI debacle, we obviously had a rub-off effect in terms of crude. And though I think at some stage over the last 2 weeks, they did come back to the table and announce a 10 million barrel kind of cut. You still had no revival because I think demand still remained extremely weak. So I think the large expectations is that a lot of analysts on the street, a lot of global analysts who track the oil and gas space, don't believe that crude for the better part of this year will move above the $40 trajectory. As I said, I think this drives a lot of shale and oil producers from the US because their cost of production varies anywhere between 35 to 50 odd dollars. Again, from the dynamics of the OPEC producing nations as well, a lot of the Middle Eastern economies as well. I think you need sustainable oil prices above that $40 mark to make a reasonable amount of money and not having a dent in terms of GDP. So, with a majority of the analysts actually expected to see not seeing crude above $40 a barrel, I think it's an ominous sign that one is talking about for the space and the effects that it probably has on a lot of sectors which are directly involved, which is obviously the oil and gas companies and a few beneficiaries who consume crude or crude derivatives, which actually have the input cost benefit. So I think this is one impact of the Saudi Russia deal, which actually had the initial crack, which got accentuated, as I said, with WTI. And I think as the figures are getting more prominent at this point of time, with the lockdowns, the pricing remaining poor because of the demand remaining soft. But some hope at this point of time with lockdowns being lifted across Western Europe, expectations across the globe as well, expecting demand coming back slowly and steadily, which might give some support and base to the price that we're seeing at this point. So there are four things that one really needs to keep in mind in terms of how oil prices uh, and then the reaction to oil prices in terms of India's economy as a whole. So I think I'll take you through the basic aspects in terms of how we should probably be reacting at this point of time. So I think the basic element or point number one would be how the current account deficit actually plays out. If you probably look at the or India's rather current account balance, I think if you look at the RBI data, which I was looking at over the last few weeks and months, I think when you probably talk about our current account balance compared to GDP, I think we had a current account deficit of 2.7% in the previous year. Again, I think a negative terrain print obviously does not augur very, very well from FPI or FDI perspective as well, because they're absolutely looking at all these statistics and parameters to probably look at investments into the country. But at this point of time, I think by the end of March, we almost had $475 billion or dollars in terms of forex reserves. The FPI investments in the country around the same period of time was almost $300 billion or dollars. So if we're probably looking at how the increase has been on a year-on-year basis of almost 62 to 63 odd billion dollars, and the comfort between the forex reserves and the FPI investment at this point of time, they're very, very comfortably placed. But what has happened also is that the rupee has depreciated quite significantly against the dollar. Not just in the past 1 month. But I think the trickling effect in terms of the lingering pain for India and emerging economies, and yes, Latin American economies have depreciated even further along with Southeast Asian economies selectively. So I think that creates a dent in terms of an offsetting effect of cheaper oil imports. So yes, I think that's a positive sign that one can draw attention from, both from oil pricing coming down, so the import bill actually goes down drastically for our country. At the same time, I think the offset happens from a rupee depreciation, though I think it is still a beneficial impact, both in terms of the forex reserves that you've got and the fall in prices that we have seen. Now, the second element that obviously comes through is how the inflationary numbers start panning out. And if you probably look at the recent report that had come out, so I think RBI had come out with a recent report in terms of inflationary checks or the inflationary impact for the manufacturing sector as a whole. So till the price fall had happened a couple of months ago, I think the expectation largely were that the median increases in inflation would probably start narrowing down in the first quarter of this financial year. With the sudden crash that we've seen, I think the median inflation estimates are expected to get shaved off anywhere between 10 to 20 bips within this quarter itself. So I think a low inflation probably augurs well, but a low inflation also probably means that pricing power does not stay with a lot of producers at play. And also, I think a lot of consumers also from the agricultural side and producers from the agricultural side. I'll touch upon that point in the next few minutes as well. So I think the RBI policy clearly indicated how that has happened. Again, I think from a CPI perspective, you probably look at the basket and the weighting of food within the basket itself. Yes, it's a low weightage percentage at this point of time, not even 20%. But again, I think one needs to take this into cognizance that this will have an impact on an overall basis, even if I think the weighted average is 20% in CPI. The third element, obviously, is the kind of impact that we've seen, and there have been arguments that have probably got raised that with crude correction happening at such a drastic level, what has happened in terms of crude pricing not coming off at the retail level itself? So there's a very interesting statistic that we have drawn out. I think if you leave aside customs on the indirect part, I think oil revenue was almost 2,63,800 odd crores in 2018-19. So I think out of the excise duties at play, 90% were generated from the oil and gas space itself. Now, what has interestingly happened is if the government wants to protect this part of the revenue, right, they need to ensure that pricing probably happens in a much more constrained or pricing cut happens in a constrained way, not a substantial manner, because they lose a substantial amount of revenue if a substantial cut comes through. So they increased on March 14, as I remember, excise duties on petrol and diesel by almost 3 odd rupees. And once a notification came for the finance bill in the last 2 weeks as well, I think it was further capped to around 18 rupees for petrol and 12 rupees for diesel. The government clearly intends to protect this part of the revenue and not ensure that it goes down significantly. Even then, I think if you're probably looking at oil receipts, it should be close to 2 lakh 50, 2 lakh 60 odd thousand crores for this year. And maybe a hit of what economists are probably believing of almost 12 to 15 odd thousand crores in that range, even if cuts come through. So whether that gets compensated from the divestment target that we've seen, now with such a direct impact being seen both for oil producers, I think even the downstream companies get hit quite significantly. Again, two aspects here. I think a fall in crude obviously is better for them because the input cost actually starts coming off quite significantly and they'll be able to maintain the marketing margin. So expect for a quarter or two where they take a significant hit in terms of inventory losses and GRMs actually remaining very, very subdued. I think the other element is demand is expected to be extremely soft, and if the refining capacities are far larger at this point of time than demand across the globe, and the storage capacity as well, are downstream companies expected to produce or refine lesser amount of crude in terms of crude throughput that they've got. And therefore, I think what happens in terms of valuations, what happens in terms of the free cash flows that these downstream companies throw, and the entire argument in terms of sustainability of the dividend yield that these companies keep on posting. So I think this is something that also needs to be observed, because I think we've got two big divestment targets set up for this year, significant one as well. And out of that, I think a significant portion was expected to come out of BPCL. That obviously the tender push has happened till the middle of June at this point of time. But if this situation and the scenario lingers for this space as a whole, I think how is the balance sheet dynamic expected to play out even from the next couple of years perspective is something to be seen, because I think these factors will have a significant say in terms of the overall valuation play as well. The second element is also that the government itself has promised free cooking cylinders to almost 8 crore women at this point of time, and that has got extended till the end of June, and it can further get extended. Therefore, I think the question in terms of a substantial cut, because I think the government also might need to substantiate significantly in terms of providing subsidies for the free gas that they need to provide for a lot of subsidized families, underprivileged families, and that is rightfully so. So I think that is some kind of hit that the exchequer will take in terms of revenue receipts. I think cheap oil being substantially passed through at this point of time probably looks unlikely. Yes, I think the adjustments might happen, because I think the general thumb rule is that with a dollar drop in terms of barrel, I think there should be at least 30 to 40 paise drop in terms of pricing at the retail level. You'll see some element of readjustment happening, but in my opinion, not a substantial one for all the reasons that I have put forth at this point of time. Now, before we go over to the impact in terms of oil and gas companies at this point of time, the other element that also happens in terms of the agricultural impact also needs to be noted quite significantly. Obviously, I think with a fertilizer subsidy at this point of time, it was close to 21,000 crores that is still needed to get meted out. I think that probably also gets put out on the back burner because of the issues at hand that we've got. So I think that is one element to be watched out for. The second element in terms of, as I said, with the RBI's report in terms of inflation expectations on the manufacturing sector and generally on the economy as well, if inflation is expected to get shaven off by 10 to 20 odd bips with the falling prices that we've seen, I think the pricing power, specifically at the retail end and the artificial produce as well, comes off quite significantly. So I think the discretionary spending that one really expected or expects to see from rural India, whether that gets delayed, because the Rabi crop will be out in the market over the next few weeks, so you'll also be looking at first signs in terms of wheat production as well. So how does the pricing emanate from an agricultural perspective? With low inflation, I think you're expected to see pricing power not return to the fullest for the rural sector, which means that the discretionary spending that one looks at might also come out with a delayed lag effect of a couple of quarters. So I think a lot of these low discretionary spending items, FMCG companies, low discretionary on the consumer staples side, which are having ticket sizes of less than 500 rupees, which includes a lot of the low discretionary stuff. I think that probably might get pushed through in the second half itself. So I think everything is getting pegged in terms of demand recovery for the second half, expectations of pricing power coming back slowly and steadily in the second half. And therefore, I think an impact in terms of all the volume growth led pricing for these companies in the second half itself. I think that's a tall ask that we are looking at. I think the annualized cut is given, but I think the second half recovery is something that we are building in at this point of time. If it gets delayed for any reason whatsoever by a quarter or so, I think you're going to probably see earnings recovery for a lot of these sectors, which are also being very, very buoyant at this point of time, and happening on a very, very consistent basis, actually getting pushed through in the first half of the next financial year. Yeah. So I think this is something that also needs to be kept in mind. So before I move to that, I think there's one element that we need to also discuss about in terms of domestic gas pricing. We've discussed oil at length, but again, gas pricing is something that needs to get discussed at length as well. So again, it's a very interesting stat in terms of how domestic gas pricing is determined in India. Obviously, I think demand supply dynamics is something that gets played out from any commodities perspective. But our pricing mechanism is based on four odd baskets of global gas benchmarks. So you've got the US Henry Hub, you've got the Alberta gas benchmark based out of Canada, the NBP out of the UK, and the Russian gas. So I think a culmination and a combination of all these four gas producing benchmarks is how we determine gas prices to be. And obviously, I think we take the last quarter's effect as well. So I think whatever pricing change happens is happening with the quarter's lag, and that happens at last for the 6 months. So I think the recent gas slash that we've probably seen was based on the last quarter's gas pricing fall that we probably witnessed in global markets and all these four key global benchmark indices, where I think the gas pricing in India was slashed to $2.39 per MMBTU from 3.4, 3.5 odd. Now, largely, if you probably look at how this entire element plays out. Obviously, I think a few sectors who consume gas. So I think the gas distribution companies, for example, obviously benefit, but they also need to pass this through. So I think you've obviously seen a few of the gas distribution companies actually cut down the pricing of cooking gas, cut down the prices of LNG as well and CNG as well in certain areas that they operate out of. Again, certain areas I'll touch upon in terms of the sectoral impact thereof as well. So largely, again, I think if you see how this gas pricing mechanism has been, I think it has come off quite significantly. I think a couple of impact factors here as well. The government has rightfully and logically placed the exploration areas under the National Exploration Hydrocarbon Exploration Scheme in ultra high, extremely difficult temperature monitored areas and deep sea water areas, still in excess of $8.5 $9 per MMBTU. So that's a logical move that has happened in terms of pricing from these areas. The administrative gas prices that a lot of these state-run companies need to give and cater to for certain prioritized sectors and industries, including fertilizer companies, including city gas distribution companies, is abysmally low than the cost of gas they're producing. A case on point and an example that I would like to cite here is that ONGC, for example, the gas cost production is close to 3.6 to $3.8 per MMBTU. They probably need to sell gas at 2.3 to 3.39 at this point of time over the next 6 months. So at least for the first half, I think with gas actually having a 30-40% kind of contribution for ONGC's overall top line, you're expected to see anywhere between 3.5 to 4.5 thousand kind of a hit, broad hit in terms of the top line that you're probably talking about. With price corrections happening globally, I think it's overseas subsidiaries over ONGC Videsh Limited, OVL, as we call it, will also take a substantial hit in terms of realization because ultimately the realizations that come through trickle down to be the net realizations on the top line, which comes all the way to the bottom line as well. So I think gas pricing also needs to be considered at this point of time. So I think that benchmark, looking at the implications thereof, as I mentioned, is extremely critical. Now, coming to oil and gas companies, upstream of the oil producers, as we call it, right? ONGC, Oil India. I think anything that is there at the top in terms of price realization from a Brent perspective. So if you probably look at the last quarter's numbers for both these oil producers, the average oil realization was anywhere between 60 to 62 odd dollars per barrel. Again, I think oil and rupee consideration is extremely important. So if oil prices are coming down, the rupee is depreciating. I think both these elements need to be considered in terms of the overall impact on the top line. With oil prices coming down quite significantly, there is every expectation that the top to bottom down effect, right till the bottom line of profitability, is going to take a huge dent. And if we even move in the range between 30 to 40 odd dollars a barrel, I think it's still a significant hit that they're expected to take. Secondly, I think from a capex perspective, you're obviously expected to see capex getting shaved off because I think as realizations start becoming lower, as cash flows start becoming lower, I think the need to conserve capital and the need to conserve capex spends in drilling new oil fields and drilling new oil wells, or even the deep sea exploration perspective that one really looks at. I think that gets deferred quite significantly. With lower cash flows as well, I think what really happens, as I said and mentioned very closely before, I think with free cash flows and the operating cash flows not happening at a steady pace, the dividend yield also start becoming a huge question mark. So I think all these companies were very, very well known in terms of the attractiveness for the dividend yield that they had. But with fall in cash flows, I think the quantum of dividends that they will roll out or might be expected to roll out, I think those expectations can clearly get taken off. So this is one aspect that one needs to look at from an upstream perspective. From a downstream perspective, obviously the downstream companies, as I said earlier as well, with lower prices in terms of crude coming off, and Saudi Aramco has actually made a lot of things very, very attractive because it's the need of the hour for them to push their inventories and the production that they're doing and have slashed prices anywhere between $5 to $6 a barrel. But I think a lot of companies across the globe, whether you're talking about downstream companies, whether you're talking about companies which do the liquefaction process, the LNG companies, for example, Petronet, Gujarat Petronet as well. I think they've actually enforced the force majeure clause because they were exceptional circumstances at this point of time. So the contracted levels at which they were buying LNG and the crash in LNG prices that we've probably seen is very, very evident. It's something to be noted. They've actually crashed down to below $2, $1.5 at this point of time. And the kind of contracts that they have signed, both these companies on the midstream part, I think work at significantly higher levels. Again, I think for companies who transmit, for example, GAIL, I think the significant impact, probably from a transmission perspective, is not that significant. But what happens in terms of the petrochemical business, what happens from the perspective of the LPG business, I think all these elements, specifically the petchem and the downstream product business that they run, depend on crude and crude derivative prices. So if they start coming downwards, and as they are happening at this point in time, I think it's an implied impact that you probably see in terms of prices actually happening very, very low as well. The LPG and the gas trading business also takes a huge hit because the gas prices have come off quite significantly, which means the realization that you probably have is obviously on the lower side on a comparative basis on a year-on-year comparison as well. Transmission holds up, and with revision of tariffs on the transmission line itself increased, though not substantially at the state expected a few quarters back. That part might still hold up, but the overall SPP valuations also start appearing very, very soft. For downstream, as I said, there will be an inventory loss because what happens is they do take inventory at high levels. I think the last few months the inventory was, as I said, on the Brent chart that I mentioned a few slides ago, was on the higher level. So they would have bought crude at higher level. Obviously, as they process crude, right, and as they start marketing that, the pricing starts coming up. And though I think the pricing is still got held on, marketing margins for the downstream companies should still get held up. There is also a fuel and loss element. So I think that should also come out because with the lockdowns that we've seen, with what we've seen in terms of lesser petrol pumps being operational at this point of time, apart from the inventory loss that might come through for this quarter's numbers and the next quarter's numbers, partially because they might be importing crude at this point of time at far lower levels. So unless crude drops significantly, the next quarter should be quite reasonable from an inventory perspective, adventitious inventory as we call it. But the second element in terms of the volumes not being there and the expectations of volumes coming back very, very slowly, I think that will also squeeze the margins for these companies. So the expected cross refining margin element, as we put it, is expected to be very, very dismal for companies this time round. Obviously, Singapore margins are dependent on a lot of inputs and cracks that they monitor. So naphtha cracks, gasoline cracks, gas cracks, so on and so forth. So how the petrol cracks are, how the diesel cracks are, how the naphtha cracks are moving clearly determine GRMs. Therefore, I think the complexity in terms of all these refiners and what kind of complexities they have for their individual refining plants. The second element, obviously, is the accessibility to feedstock, where Reliance probably has the best accessibility to feedstock, and then multiple options there as well, right? From methane, and though again, refining has been only 20-25% of Reliance's business, I think their GRMs are one of the better ones, and they always outperform Singapore GRMs at this point in time. So Singapore GRMs are expected to be very, very muted. There are also new IMO regulations which have come through from Jan 1st. So any producers on the downstream part which have the middle distillate portion with them, and a few of our producers do have that, there will be a reasonable amount of resilience that can get placed. Though I think the larger picture still remains quite subdued. So the GRM is still expected to remain soft, improve quite marginally. There's a substantial hit that one can expect from a Q4 perspective, with the marginal improvement happening in the first half. Obviously, input costs with crude coming off comes off. Marketing margins still remain extremely high, are plus points, and valuations on a price to book perspective still remain extremely attractive. However, I think all these factors need to be placed into account because I think these stocks have actually got beaten down quite significantly. And I think the earnings will get revived on a consistent manner only once we see there is some stability in Brent prices and some stability of demand coming back. So I think the upstream producers, the downstream producers, the middle distiller, the middle producers, including and transmission players like GAIL, is something that we've discussed at this point of time. What happens with the gas distribution companies? Obviously, I think they depend in terms of LNG, and the LNG price is coming off quite significantly. The input cost has come off quite significantly for these players. The gas prices, as I said, have corrected to 2.3, $2.35 per MMBTU, which is a significant correction, which means input cost comes off quite significantly for these players. However, I think in terms of passing this through, I think we need to pass this through as well. So I think both in terms of CNG and PNG cuts that one expects, there will be some element of moderation in terms of the EBITDA per SCM, which is a very key parameter for these gas distribution companies at play. The second element, obviously, is the need for cleaner fuel. And with the numbers in perspective at this point of time, obviously, with the petrol stations coming off, with industrial activity coming off, a lot of the CNG activities from petrol stations off, and a lot of the PNG activities from an industrial PNG perspective coming off quite rapidly, you might expect to see Q4 and Q1 numbers actually remaining very, very soft. And therefore, I think the expectations is that even numbers on this scale should be muted, at least Q4 and Q1 are concerned. But with volumes expected to increase, with the efficiency expected to increase around to the full optimal capacity, even if EBITDA per SCM comes off over the first half, with new geographical areas being discussed, with the capex happening in a very, very constrained manner for these new geographical areas over the next few quarters, I think the volume-led growth should be quite significant uh, for gas players as well. So gas players probably might remain in a sweet spot over a medium to longer term duration, with expectations of both crude expected to stay low, demand expected to come back gradually, and the trickle effect in terms of crude derivative prices, including gas prices, expected to stay low, having an effect in terms of LNG prices staying soft, creating huge multiple positive impacts from input cost deflationary perspective for these consumers at play. Now, a few of the sectors that obviously benefit, right, from a lower crude price. I think it's an obvious element here. I think one does not need to ponder which sectors will benefit quite substantially with crude coming off. So, aviation, fertilizers, paints, plastic, polymers, ceramics are all the sectors which benefit quite significantly. For aviation in general, I think the fall in crude prices of ATF prices, as we've seen and witnessed, is a boom. But what has happened with the lockdown and all the planes getting off, Q4, Q1 impact will be quite substantial. Again, I think the demand recovery in terms of how the customers will come back and how flying will take place both domestically and internationally. I think it's going to be a very, very slow and steady ride. So though input costs have come off, I think the effect in terms of utilization levels or the load factors from a passenger perspective might be quite subdued, at least for the next couple of quarters. Pricing again might not be on their side because they might still need to be very, very competitive in terms of keeping their pricing very, very attractive to actually attract a lot of travelers coming back. And it will happen over a period of time as this pandemic gets over and as things start stabilizing in terms of travel as well. But at least for the next, at least for this first half and the quarter as well, I think the effect in terms of PLF, so the passenger load factors coming off, coming back very, very slowly, the yields actually coming off, and then the input cost staying high, even if petrol or the ATF prices come off, which is almost 35, 40 odd percent in terms of overall input costs. The other costs in terms of the fixed element and the operating element as well, I think they still remain extremely patchy, which means that the overall reported numbers on the bottom line remain very soft. The other element also is the kind of planes that they are using. And I think a lot of engine issues are being faced by both the listed entities at this point of time. Again, with lockdowns happening in Western Europe, that obviously gets delayed because there was large expectations that these things will get resolved by the end of June. This is clearly getting delayed to the second half itself. So I think everything gets pegged off to the second half from any sector's perspective. But for them in particular, I think this will still remain as a sore point because they still need to incur quite substantial operational costs for the old aircraft in terms of both maintenance that they need to incur and also the fixed parking charges that they need to pay off in terms of the planes that are parked, with more revenues being recorded on the top line. So I think this is something that will have a very, very slow and steady recovery at this point of time. Though I think any package that gets announced and when that expectation is in terms of the financial package, and we are waiting for all that from an Indian perspective, on which sectors will get addressed and to what extent that package happens. There might be a sentimental impact if and when into the quantum of the package that gets announced for either or any of these. The second element, obviously, as I said, when I touched upon in my opening slides that I mentioned, I think fertilizers. With the fertilizer subsidy coming off, because I think the government has larger priorities in terms of subsidized cooking gas to be provided to protect the revenues, as I said, from in terms of excise duties that they collect from crude and so on and so forth. I think what happens in terms of the subsidy payout on fertilizers also gets deferred to the second half or probably to the first half of the next financial year itself. The second element, obviously, is in terms of gas prices coming off quite significantly. So I think the important element for a lot of fertilizer plants which are moving on gas do get positively impacted. So the kind of input cost that comes off quite significantly is a huge amount in terms of the reported EBITDA numbers that they've got. Secondly, I think Kharif season is around the corner, and partial production has started for a lot of these agro processing companies as well. So for a lot of companies that play here, there are positive expectations that runners. Yes, I think the earnings it is a given, but I think with expectations of Kharif and expectations of takeoff happening at the dealer level, I think the inventory levels that one was talking about should get disposed of. And again, I think anything new that they're expected to produce might also get stacked up at the dealer end from a perspective both for the Kharif season and the upcoming Rabi season as well. Obviously, paints get impacted quite significantly as well as adhesive players because crude derivatives are a very integral part in terms of the cost that got almost 25% off in terms of the titanium dioxide that paint companies produce. Companies like Pidilite, for example, I think almost 25% of its cost is from the vinyl acid monomer prices, which is also indirectly or indirect relation to crude derivatives as well. So I think lower crude prices obviously means that input costs come off, and that has a positive say in terms of EBITDA as well. But the only element here again is the demand recovery. So the expectations are largely that Rabi coming in, the repainting demand for a lot of these paint companies should have started off. They've obviously got impacted, but a lot of industrial paint companies, which is only one which has a substantial say at that point of time, with the lockdown pressures, will see the pressure coming up. But with the demand coming back slowly and steadily as well, paint companies, in terms of the volume growth that one really expects and was expecting of almost 11-12%, that's the general thumb rule of around 1.5% of the expected GDP is how volume growth actually happens. So if the expected GDP is expected to shave off quite significantly, you can very well expect that volume growth can actually also start taking off with the assumptions of 1.5 of the GDP number, as I discussed even last time, that IMF expect of almost 2.5% for India at this point of time. So how this volume growth plays out is going to be extremely critical in terms of demand coming back. But input costs coming off is definitely a positive sign, at least from an EBITDA perspective. So from a result perspective, I think management committees, as I've said, is going to be extremely critical in terms of how they look at the landscape, specifically for these discretionary companies on the patterns going forward. Plastic polymers obviously benefits quite significantly as well because both in terms of input costs coming off and in terms of actually PTA prices both from a crude derivative perspective and a plastic downstream perspective as well, even from a polymer perspective, is expected to play out quite significant. For ceramic players, I think they use a lot of gas, so the gas prices coming off quite significantly. Ceramic players actually start benefiting quite significantly. But again, it's a cyclical story like faiths. So what happens from a demand perspective? What happens in terms of the demand outlook itself? I think that is going to be extremely critical. Because if demand remains extremely patchy and very slow, I think that itself will emanate in terms of lower volume growth. And all these companies which depend on discretionary spending pattern, I think it is a demand-led price growth. So I think it's a volume-led price growth which creates operating leverage on the balance sheets. So if one element is missing out of this two, I think the entire trickle-down effect is probably not felt on the bottom line. So I think the price correction that you probably see in gas prices is expected to benefit what we've seen in terms of a lot of these ceramic and tile producers. I think speaking to a lot of these channel checks that we do, I think Morbi units had come back quite significantly over the last few quarters. What had happened in terms of the lockdown pressures was that you had probably seen volumes actually degrow for these companies in this quarter as well. And there is a monsoon season as well, which is expected to also dampen a lot of these production activities at play. So yes, there are all these elements at play here. There will be minimal impact in terms of crude prices reduced in terms of a lot of the infrastructure companies. So I think a lot of these cement companies where freight costs are also a significant portion. I think if pricing starts coming down, that will also have a significant say. Because a lot of these OMCs are also indirectly attached to that. Because a lot of these OMCs, including IOCs, HPCL, BPCL of the world, if you look at their sales pattern for the petroleum products itself, 41 to 42% is from diesel sales, 16 17% odd happens from petrol sales as well. With a lot of industrial activity locked down, that also is a significant portion that needs to be considered. And if prices come off a tad bit, I think that indirect benefit partially gets through for a lot of these companies which have freight costs, which includes logistic companies, cement companies at this point of time, which will see some element of shave off happen in terms of the costs. So, I think a few stocks, and this again is just generally in terms of an educational purpose as well, from how we look at the only lens. So I think I'll just pause for a minute and take you through. As I said, I think gas distribution companies probably over a longer period of time probably remain in a very sweet spot. Companies like IGL, MGL, Gujarat Gas, who I think quite prominently dependent on the industrial activity and specifically industrial activity out of Morbi that I was speaking about. I think whether they'll be able to pass through their prices quite significantly because gas prices is one element to it. But with the fall in LPG prices, I think whether these players also opt for LPG pricing or how Gujarat Gas slashes his prices, if that is the case in terms of his pricing dynamics to compete against competing fuels like LPG is something to be seen. So I just pause for a minute and then let you go through this one. So this is the graph for Gujarat Gas. If you probably look at IGL's graph, and as per our analytics on the evaluation sheet on MarketSmith India, so the product or our graph is clearly showing out how the impact is. As I mentioned in my earlier webinars as well, I think our software makes it very easy for end users. Left hand side, you can see the fundamentals. There are also detailed fundamental graphics in terms of balance sheet and P&L, and the patterns are actually getting drawn out in terms of moving averages. It's forming a cup pattern at this point of time, and it's sustaining above its 21 and 50. So how does it sustain over the next few sessions in the next few weeks? It's going to be very interesting. Similar story in terms of Gujarat Gas. So the pivot levels. If you look at the right hand extreme column, 17% pivot. So our belief is that as the earnings start coming in and as price volume actually starts getting built up, historically seen and seen over the past future as well, from earnings expectation perspective, I think the stacks that get built up from a candle perspective, it's still a long way to go till it's the pivot. I think the pivot level is very important level where one should take some actionables into the stock as well. ONGC again, we've seen the drastic impact and the expectations, as I've mentioned, in terms of numbers that can still get paid out for upstream companies. So I think as ONGC is one of the more prominent upstream companies at this point of time, you can actually see on the left hand when the chart is getting exhibited on how the numbers have actually played out. So if you probably look at the June, September, and the December earnings or the EPS that they posted, it's actually showing a downward trajectory on a comparative basis on a YOY basis, which basically means that the kind of hit that analysts are expecting, the price is probably reflecting the same, and it's clearly broken down, and it's below all its key moving averages. And our four key parameters, which are there on the left-hand side of the screen, are clearly indicating that as well, both from an EPS perspective, from RSI perspective, and even from a group ranking perspective, from where it is placed at this point. As I said, both for the middle companies, which includes Petronet and GSPL at this point of time, yes, I think earnings have probably held up. They've probably enforced force majeure clauses at this point of time. But what happens in terms of the overall demand growth itself, and what happens in terms of the overall S&P valuations when you're talking over a longer period of time, I think it's something that needs to be observed and seen from a larger context, both from an earnings perspective and as the graph and the data graphs are showing on our markets with product at this point. I'll just take a couple of minutes. I'll pause here. So we will take some time out for queries at this point of time. So let me just stack up two queries over the next 2 minutes, and then I'll probably answer a few of these queries.